Hello, and welcome to the Freight Find Podcast, your source for all things freight transportation. I'm Chris Kaplis, Chief Scientist at DT Freight and Analytics, and thanks for joining me today. This is our first video version of the Freight Find Podcast. If you're listening on audio, you can also watch this episode on YouTube. Either way, we'd love your feedback on the format. My guest today is Chris Pickett, Chief Commercial Officer at Flock Freight, as well as the founder of Pickett Research. Chris returns to the podcast after being gone 6 years. He was one of my first guests coming on during the pandemic, and obviously a lot has happened since the spring of 2020. In our conversation, we discussed the evolution of freight brokerage from his days building Coyote Logistics to his current focus at Flock Freight. He details how Flock is establishing Shared Truckload as a distinct mode from LTL and truckload, allowing shippers to pool freight within corridors to reduce costs and carbon emissions. We also discussed the Pickett Line, Chris's proprietary market analysis tool that he developed that highlights and identifies both the timing and the amplitude of the truckload market cycle. Chris reminds us always that while history might not repeat, it certainly rhymes, and he's issued some bold warnings for shippers. He said prepare for a potential 45% surge in spot rates and double-digit contract increases, 11% by the end of 2026. It's always a pleasure to talk with Chris about trucking. I encourage you to take a listen and learn something new. Now, following my conversation with Chris, I'll present the latest truckload market update. So, let's get started. Hi, Chris. Welcome back to the Freight Find Podcast.
Glad to be back, Chris. It only took 6 years for you to go through your possible attendee list to see my name come back up. So,
you know, I had a lot of cancellations, Chris, and so you're on my call list.
Guests out there's a lot of great guests out there.
No, you are. I looked, and it was April 2020.
April 2020. It was early COVID. The world has changed. What are supply chains doing?
Yeah.
What was sheltering in place? Supply chain out. On premise. Restaurants. Food consumption was quickly shifting to eat at the home, and what is this brave new world looking like from a?
But we all thought it was going to be over by the 4th of July.
Yeah, absolutely.
Right. We had no clue. And so, so we were in a really soft market, right? 2019 crashing. And then, the pandemic was starting to hit. But if at that time, I think in April, weren't carriers still protesting in front of the White House?
We were protesting. I was like a 1.5 year period, the last deflationary, downturn through 19. Market was poised to break inflationary, then suddenly everything stopped in April. It's actually April 2020. It's the first stage of shelter in place. So the entire auto industry was shuttered, and that's exactly for this very short period of time. Spot rates plunged 4 or 5% and that's when the truck drivers caravaned or convoyed kind of down to DC to express their discontent, and then when spot market rates surged a month later, suddenly they forgot all about that.
Yeah, they weren't protesting anymore.
They were not.
It's shocking.
No.
So a little bit has happened since then.
A little bit.
An entire market cycle, actually. That's
Yep.
why I couldn't bring you back. I had to wait till the cycle finished.
Exactly. It's been so painful how long this one is taking, because I knew I wouldn't get my chance to get back in the freight find until.
Yeah, we'll have to talk about when we talk about the cycle, because I have a new term for what happened the last 18 months.
Oh boy.
But we'll talk about that. But let's start. People who weren't here 6 years ago.
Yeah.
Tell us your quick journey. How'd you get to be where you are now at Flock as well as at Pickett Research?
Yes, I did not grow up in transportation. Grew up on the East Coast, Northern Virginia, outside of DC. Studied industrial engineering at Virginia Tech. Graduated in '98. And then coming out of Virginia Tech, wasn't really sure what I wanted to kind of do with my life. Did some internships at factories and DCs. This is what IEs tend to do. Kind of fell out of love with going into manufacturing. I'm fascinated by complex manufacturing.
Mm-hmm.
In love with kind of the orchestration of things that had to kind of come into place to get product from some point of production to some point of consumption. And without knowing what that meant, at the same time, the internet was becoming a thing, which is kind of tried to talk about that way. But this is 1998.
But it's so funny though. You got to think back, because it's hard to think that it was ever different.
No.
And it was so different.
I got my first email address, maybe my sophomore year of undergrad. Did not have a cell phone yet. So, but, e-commerce was starting to kind of become a thing. So I thought, hey, I want to try to be smarter on tech, but somehow tie that to supply chains. So ended up taking a job with a consulting firm, ended up being Anderson Consulting back before they split and became Accenture. And so they were on campus hiring engineers to go and, train how to code. And so I think, sure, let's do this. Ended up landing in their San Francisco office. And so without knowing what was coming from a .com kind of boom or internet revenue.
So you were in San Francisco in what, 99, 2000?
Summer of 98, with an engineering degree working for a technology consulting firm. It turned out it wasn't a bad place to.
Not a bad place to be.
Every other guy you met at the bar on the weekend just raised, $5 million to sell pet food online or toys or water or diapers or whatever. That was the vibe.
No, I remember that because at that same time, I was with logistics.com, of course, because that was the name of the company. But the big motto was, lights out. We're going to disintermediate the market. Yeah. Lights out strategy.
So we ended up, doing that for about a year and a half. We're a consulting firm. Of course, everyone's trying to get staffed on the sexy e-commerce projects. Yeah, Amazon, eBay, AOL, right? For God's sakes, right? You're raised a boatload of cash. We're hiring consultants to build stuff. So I ended up kind of on the opposite side of that. Spend most of my time there in telecom, building E-frame billing applications for AT&T. So I became a database developer, supporting COBOL-based, development teams. So raised this a little bit on mainframe apps, but learned a lot about, applying technology to the kind of unsexy corners in the universe that when it was phone bills, later became trucking. So there for a year and a half, then ended up going to a startup, which again in the late 90s in San Francisco, you would end up at a startup at some point.
Sure.
So with some guys that I'd gotten to know at the consulting firm, went on to raise $84 million from SoftBank and some others. Basically, we're going to build the internet fulfillment backbone. Right. So all these expired merchants flocking online to sell crap, had no idea how to get stuff physically from point A to point B. And we developed a constellation of integrated fulfillment partners and built the kind of application layer over top where everything from submit order to return, final sell. And this is 1999.
And when did the shoe fall?
The shoe fell in 2001, kind of slowly. Then all of a sudden, it's 100% B2C focused. And then eventually the market, told us that we didn't need 17 different pet food.coms. So as our market kind of, waned and imploded, we ended up not making it through the IPO window and got, sold into kind of a sister portfolio company that had a better chance of getting monetized by the VC backers. Their product mission less interesting, but at that point, it kind of had caught the early stage venture bug of, hey, I didn't even know this was an option. Like you could find folks to kind of, like-minded, different backgrounds, go out and raise some dough and try to do something different in the industry. So I kind of caught the bug. But at that point, all the capital that was flowing into the Bay Area was getting sucked right back out.
Yep.
So I thought, well, shit, no one's going to give me another $86 million to go build something all 24 years old. So let's do kind of the next best thing. I was kind of joking, if you're not sure what you want to do with your life after college, go become a consultant. And, And if you've done that, you're still not sure what you want to do, go to grad school.
There you go.
And I go to MIT, so the Masters of Engineering, back when it was still the envelope program, just before you came in. But the idea was, hey, if I can go and kind of maybe put myself in a position to find some like-minded entrepreneurs, do something back here at the intersection of, tech and transportation, logistics, supply chains, that would be a cool thing to try to figure out.
And the amazing thing is that in your class of 2003 was Jeff Silver and Bill Driggert.
Yeah, so found myself in a cohort with Jeff Silver and Bill Driggert, exactly that, where Jeff was coming off of a successful first foray into non-asset
American backhaulers.
Had sold their business to C.H. Robinson in 99, ended up leaving, had a 5-year non-compete. So, why not go spend that at MIT?
Yeah.
Dude. So got to know Jeff, got to know Bill, got to, I think, discover freight brokerage. I had no idea that there was this intermediary layer of, tens of billions of dollars of value in just connecting fragmented supply with fragmented demand. And then what you could do if you apply technology and maybe in novel ways to help that, run smoother. At that point, the industry seemed to be very under-innovated, from what I heard, from what Jeff had told me. So we had ideas of how we could apply some of the, ESD 260, nerdy supply chain pixie dust into the industry with modern technology to maybe drive value someday. So at that point, as we were finishing MIT, and you were coming in, this was 2003.
Spring of 2003. Yeah, I joined.
The idea was, hey, are people getting funds? Are the cool startup ideas out there? And in 03, I didn't find any. Jeff still had a couple of years in his non-compete.
Yeah.
Kept in touch. So
what's interesting, Chris, just as an aside, as you were launching out of grad school, my experience at a .com was spiraling down the tubes. And so I came to MIT because, the logistics.com, not so much. And it then got acquired by Manhattan.
Similar journey, right? Different, different timeline.
Yeah, yeah.
I ended up going down to Georgia Tech and actually did a 2-year MBA. And then reconnected with Jeff pretty soon after that. This was, summer of 06. As Coyote started to take shape, Jeff had joined Bill first, and initially it was going to be a software company, build bigger, better, faster TMS software for brokerage. And then, pretty soon pivoted to, hey, we think there's a bigger opportunity at a large scaled, non-asset based.
Right.
So
and then it was.
So I got the call, ended up moving up to Chicago in, October of 2006. And
if you're listening to this podcast, you know what Coyote Logistics was and became, and now to UPS, acquired now by RXO.
So,
and you've been gone now for how many years? When did you end up leaving?
Left at the end of 2020. So it's been 6-ish years. Yeah, about 6 years.
Okay. Yeah. So when you first jumped off, you founded Pickett Research, and we'll talk more about that in a second.
The whole purpose around Coyote was, hey, here's this massive, $800 at that point, $900 billion, right, truckload industry, massive fragmentation,
right,
massive applications for technology. If you do things just a little bit better, we didn't sell anything new. We didn't invent anything. It was just we did non-asset based truckload brokerage. We think just maybe a little bit better by leveraging.
So what do you think was different? What? Because there was a key differentiator, and I'll tell you what I thought it was after, but I want to hear what you said. What's the differentiator that made Coyote special compared to the other brokers?
We did have purpose-built tech, right? So that is one thing. We blank slate, hey, what works in this industry? How do you think about aggregating networks? We did have a novel organizational model where we never even tried to build a branch office, kind of cradle to grave platform. It was very much a single holistic capacity network, where the idea was, we want to find the best truck for each load every time. And usually the best truck tends to be the closest truck. And so if you can build a network of enough, dots on your map, then over time,
density,
you get better at matching, trucks. And that becomes your competitive advantage with scale. There's a misunderstanding around, why does it pay to be big as a non-asset based brokerage? Not because you could extract, better rates from, these poor unsuspecting owner operators. You just match better. And so build a network to identify closer trucks over time. It seems silly to talk about like that, but you'd get better at, less deadhead to subsidize, better on-time performance, because less stuff can go wrong if you're dispatching a truck from 25 miles versus 250. So as you scale that, then more capacity network, you become more attractive to shippers because it's better price, better service. I would like to go more.
So that's probably always been the approach, density.
Yeah.
But the way to achieve density prior to this for brokers is have regional offices. Yeah. Right. And so to me, that was the key differentiator.
Well, P&L. And then, of course, when you can't talk about Coyote without talking about culture and what kind of Jeff and Marianne had built around. Okay, there's density for sure, right? There's the tech, there's the robot, bringing, but then I think there's the heart of the business around how do you deliver differentiated service when you don't own the trucks or employ the drivers. You get there by having an army of, mission-driven, super motivated, supportive, coyotes that, are living, kind of the values with every transaction and doing the right thing when no one's looking, for the driver, for the carrier, right, for the shipper, right, for each other. And then cultivating that as you scale, and you end up creating a pretty compelling flywheel where it's okay. You solve that, then it's just, how do we deploy capital efficiently, hire at the right cadence, bring in the right people that kind of fit that profile.
But let me ask a question, because that's so the first thing you said was the purpose-driven tech.
Yeah.
So absolutely, you guys have built the tech specifically for how you wanted to operate your model.
It was the break forward to people. So it's you build, you find, mission-driven, competitive, motivated people, but then give them the ability, give them the tools.
So my question is, of those two, which is more important? And you can't say both.
Yeah, it's probably the people. I mean, honestly, it is.
Yeah. And that's really, Marianne, I mean, having that culture, that's a hard culture, because it was a very hard charging, straight out of undergrad kind of culture, wasn't it?
Yeah, it was super fun. And that was, I think it's awesome being part of startups that are growing, because it allows you to create an environment to give folks a lot of accountability and a lot of space to run. And well before, right, their resume would justify it. So it's a sort of path. I mean, that's, honestly what, made me fall in love with the model, where it's, you show up at the factory or the big consulting firm or AT&T, and it's, okay, here's your career guide. And here's, if you show up and work really hard, here's what the next 20 years might look like. It doesn't matter how smart or motivated or creative you are. Just show up and work hard, keep your head down, and this is it. Versus, here's a blank page, you write the playbook, and here's what we're out to accomplish. And doesn't matter what you did before, or, who your parents are, how much money you have or don't have, or kind of what background you have, or what degree you don't or don't have. It's, what can you do? And if you can demonstrate, competency, then hey, you get to do more. And I think phenomenal careers were built, by I think creating that environment and giving folks the tools and the room.
Yeah, it's always interesting to see if a company, whether it implodes or whether it's acquired, because it's like a dandelion. Like the people leave from Meltor and they go, it kind of seeds the industry. And so it kind of sees where people go. But let me go back to something you mentioned about being in the right spot at the right time. San Francisco, turn of the century, when things were happening and the boom and the bust. Do you think the same thing's happening with AI? Because right around the time, we overbuilt in copper cable, all that kind of stuff. And people said, oh, we'll never use this. But that capacity helped us 10 years later. You look at the AI bubble now. Are you seeing the same thing?
I think probably. It's hard to say. I mean, there's absolutely similarities. So I think over the long term, it all works out. But I would expect there be some, busts along the way.
You don't think this time's different?
No, rarely is. It's one of my favorite taglines. Most dangerous forwards and financial markets are afraid to say this time is different.
Yeah. Well, let's go to where you are now, Flock.
Yep.
So you've been there for how many years now? When did you joined initially
Almost
as an
5.
advisor?
Yes. Well, no. So I left Coyote officially end of the year 2020. Kind of became an unrestricted free agent. January of 21. So Pickett Research that January. And I didn't leave Coyote to come to Flock. I think I left Coyote just to do something else, and much longer story around. UPS was a great partner and acquirer
right.
until they weren't. But at the time, it's just we had kind of stopped innovating in a lot of ways, and it just wasn't as much fun. The people that grown up there, what they're kind of respected and admired, are going on and gotten poached away as they should to do different things. So, seeing everything that was happening in the industry in terms of the degree of investment and the innovation, let's figure out what the next adventure is going to be. It's probably not going to be here, but left best of terms. Still a lot of great, plenty of folks I still admire and respect at Coyote now are. So it was a great exit or transition to the next thing, and then ended up figuring I'd be out for a year or so and try to find some novel piece of technology out there. And I think the more I looked, the less inspired I became. So a lot of apps, a lot of driver apps, a lot of
absolutely
things that didn't seem that interesting, and then ended up getting introduced to the Flock team. As is often the case, people start to show up at different places. So some of the actually really smart, coyotes that I'd kind of grown up with had started showing up at Flock. They started raising a little bit of money on this idea of shared truckload, multi-stop consolidation. And so the idea of taking LTLs and combining them to multi-stops is not a novel one. And so I think I was aware of what they're doing, but honestly, it didn't pay it much mind. Neat idea, cute. We kind of think of these gnarly, 6-pick, 6-drop LTL routes that third pick goes sideways. And you have cascading service failures. So it's really a thought of, if you could do it, because I don't know that you can. Can you make the math work?
Yeah.
Can you make the operations work? But like, even if you could, how interesting is that? Like, how much of the LTL market could you cleave off as a premium kind of substitute? So kind of discounted it, but got to start to be introduced to the founders, Warren Zaslansky, Lou, who runs TechForce, more to kind of understand the model, more so to kind of advise on pricing cycles. So we're still sourcing much of our capacity on the truckload market. Truckload market is still very cyclical, but by definition.
Absolutely.
So got to know them, got to, I think, start poking at the model. And the more I poked, it was less about, shared truck was a premium substitute for LTL. And I'll talk about kind of the difference in a second. But if you could actually take that same model and approach and solve the underutilized truckload problem at the same time, because certainly my experience at Coyote, plenty of times shipper would send over, loads 10 inches full truckload. It's got 6 pallets on it. It's got, half a truck. And we're getting it because we're the cheapest full truckload carrier in the routing guide. They don't have an LTL alternative. Once we get the load, hey, it's light. It's easy to move. Even if we could go find more freight to put in the back, do we really care? No, not really. Let's move on to the next thing. So Flock's founding hypothesis was, hey, there's, we think the upwards of 20 to 30%, maybe higher, just wasted capacity, shipping air out there in the marketplace because shippers don't have a consistent way to buy partial truckload capacity, if that makes sense.
Right. So to your point, Chris, this isn't a new problem or a new opportunity, but no one had been able to solve it well. And mathematically, you can do it on onesie, twosie, but actually pulling it off seems much harder, much more difficult. What attracted you to join the fight?
And so I think it's, once a sense of how big that market could be. So, hey,
Okay.
here, if you can crack it, if you can figure it out, and at that point I still don't know we could, and, have a, alternative to, and it's not bad LTL, but it's, hey, I'd rather have my stuff move faster by not going through the traditional hub and spoke. So that just means, hey, if you think about, a traditional hub and spoke LTL consolidation network without the consolidation points, we're effectively consolidating on the truck en route versus at, hubs and terminals as it hopscotches way across the country. What if you could bypass that, still get comparable unit economics, but skip the extra handling, moves faster, much less, much more, much less variable transit time. So if you're trying to avoid OTIF in the big box retail, this helps you do that more effectively than traditional LTL in some cases. So if you could solve for that, but you can also solve for the underutilized truckload problem. And I think this is kind of during the height of COVID, right? Where it's, every day was, port congestion, crumbling infrastructure, perpetual driver shortage. What are we going to do? The infrastructure is falling apart. But at the same time, 30% of the capacity on the road today is wasted. Like we're just not even using it as an industry. So if there was a viable way to unlock that and make it available, fill out the capacity that's on the road as we're anxiously awaiting alternative fuel technologies, whether it's battery or hydrogen or all the stuff that's eventually coming, could you mitigate unnecessary carbon emissions? Right. So this idea of you could solve, bad LTL in some cases, solve the underutilized truckload problem, mitigate 20 to 30% of unnecessary carbon emissions, and still yield a very attractive gross margin profile because of the way the math works. Holy cow. Like if you could pull that off and actually establish shared truckload as a viable, discrete mode option right there between LTL and FTL. And
do you consider it a third mode, or do you consider it closer to full truckload or LTL?
Where do you full truckloads? But also what we're selling is it's truckload service, which means same truck, same driver, no terminal consolidation. Your freight gets touched twice, once on, once off. You get truckload tracking, only paying for the space that you actually need. So it's more akin to that, and it's different than LTL because there are no consolidation points.
Yeah, because most truckload carriers hate multi-stop.
Correct.
Right? Because it just causes those problems.
No one's done it well because no one works on it, right? So to make it work, you have to basically condition shippers to understand there's differentiation, and then there is a different mode option you can count on. You can load it up in your TMS, and STL should be a mode option to pull that lever when it makes sense. Then you also have to win the hearts and minds of the supply side that have grown up, being proven time and time again that multi-stops suck because, hey, I signed up for a, 2-pick 2-drop or whatever the combination was. It was supposed to take 3 days. I mean, paid $4,000 and ends up taking 5 days. And I got paid 2 layovers because stuff kind of went wrong. Geez, I'll never do that again.
Yeah.
So it's trying to, I think, create consistency and trust. Why would a carrier want it? Because we're unlocking underutilized capacity. You're making more money. And the way the unit economics work are such that you've got half a truck of stuff that you're trying to get from Boston to San Diego. I've got a half a truck of stuff that I'm moving from, maybe it's, Allentown to same direction. Maybe it's delivering Kansas City on the way. Without Flock, you're going to tender to a full truckload broker carrier, and you're going to pay a full truckload price because that's what you should do. That's your only alternative.
Yeah, sure.
We'll say, don't do that. Here's a rate that's say 75% of your truckload rate. It's not half, but it's 25% off. That's material. Other guy or gal gets the same deal. And we don't know about you at the time. We're making a bet based on shipments showing up that we'll consolidate.
Right.
So you have 2 shippers saving 25%. Now we kind of have, theoretically 150% of the revenue in the load. We can pay a motor carrier 20% more they would make otherwise. Same miles, rate, same time. If we can mitigate, take the suck out of the extra stop and yield an attractive margin profile to reinvest in the platform.
How do you minimize the degradation of service? Because, if you have something from the same origin or right along the route, that's awesome. But you're going to have some circuity, right?
And that's the rub. That's why no one's done this at scale. And so why hasn't someone done it? It's not a new idea. They need kind of 3 things to make it work. One is the tech, and there's kind of 2 pillars of IP. One is just the routing. As you'd expect, there's the routing algorithms. Right. Kind of a traditional, it's not even an ML optimization. It's more of a traditional OR approach. The ML comes into play in terms of shaping all the inputs into the model, but it kind of runs on permutation math as these things do, where if we've got, say 1,000 shipments that we could pick up today, 1,000 tomorrow, and 1,000 on Monday, there's 120 trillion permutations of how this freight can be put together. And so the system is constantly grinding through and very quickly filtering out the infeasible options for a billion different reasons. So you quickly come up with a feasible set. It's constantly optimizing the entire network to identify of these, what's the combination that allows us to best chance of hitting service, maximizing the savings of the shipper. And then once you run out of time, you can't do this forever. Eventually, you have to release the load to match it to get your first, truck dispatch to pick up the first stop on time. Then it releases, and then it's, then that load is managed like a traditional non-asset based network where we're tracking the driver in route. But there's a lot more downside if we have issues in transit or at those stops in between with the service degradation. So the short answer, build by scale and mass. We have to have enough Tetris pieces where the system kind of self-heal. Absolutely. And we have to be able to predict, with high degrees of confidence, transit times, dwell times. You told us 4 pallets. Do we believe you? How reliable are you? Usually if you show up and you say 4 pallets, there's 6 pallets, or there's 3 pallets. How do we account for that? But in there, it's still just good old-fashioned hard work, and you still need to have, that kind of kernel of mission-driven, enthusiastic, passionate, employees like we had at Coyote, that have the tools, then the math to kind of support them on how do you manage, that level of complexity at scale. And the vast majority of our pools have 2 freight bills. So this is not the 7 pick, 7 drop, gnarly LTL, edge case that I talked about. Like 95% of the pools have 2 freight bills. But it's just 2 picks, 2 drops versus like a traditional 1 pick, 2 drop, 2 pick.
Was that what you expected?
Not at first.
Yeah.
I thought it was dumb. I was like, there's no way you can pull it off. And if you could, it's not a very big market, but just the level of complexity. But it, to some degree, in terms of, it makes sense now in terms of where the savings is.
Yeah.
LTL shippers are buying shared truckload to save direct freight spend. When you add it all up, they are. It's just less touches, less damage, better insurance. There's less, no reclash reways, all of the
right
goofiness of LTL. The greatest adoption is with those truckload shippers, where your next best alternative is truckload. So those tend to be larger shipments that get priced in.
Yeah, but less than that. But 2, I would have thought it would be closer to 3. I mean, you don't have, it's not 100. You said it was 90, 95%?
95% or 2 pick, 2 drop.
Wow. I would have thought it would be at least
over time it folds in. I think it's function kind of how the variable pricing works. And then again, if it's...
Let me ask about the pooling and where is it mainly focused at common origin?
No.
Common destination? Or do you look at corridors? Do you look at
it's corridors. So it started as kind of, hey, it's fine, which is trying to traditional consolidation network. Yeah. I've got some local LAs and I got a spot there, and it's going to come to my it's a consolidation point. And once enough freight stacks up to get a full truck, they'll ship to Chicago. Then I'll do last mile. And so when I think first started, a lot of those inherent pools were clustered around, LA Inland Empire, going into the Midwest or north to NorCal or towards Atlanta. But over time, as that fills in, you would think about density less so as metro areas, more so as corridors.
Yeah.
And so a lot of what we'll pool is anything with, between, Ontario, California and Dallas, or Dallas to Atlanta, or Chicago, or even the Northeast.
Was that what you expected going in?
No.
Yeah.
But I haven't been thinking broadly enough. It's like when some of these pools are, quite breathtaking when you look at them, like it identifies as solutions on a map that you or I or any human being would look at it. A planner would say, there's no possible way that makes sense. We look at routes these things come up, whether it's like, holy cow, then do the math and say, wow, it saves you $300. This makes
but that makes it a lot harder. I imagine you have a team that are marketing, that are trying to find density, find shippers that are moving. It's easier to find a shipper that is, origin, where their DCs are, where they're going to. So much harder to find corridors.
Yeah.
How do you target corridors?
Kind of takes care of it, right? So we talk about there's 2 pillars of IP. One is just the pooling tech, and there's like a dozen different ML models that are embedded into just trying to create better predictions around solving for the freight you already have.
Yeah.
The other piece is pricing it. And so when we're going out to price, it's, well, how attractive is shared truckload? Do I care? Well, what are you trying to solve for? If it's cost savings, you're comparing to your next best alternative. So when we're pricing, it's a function of what's our underlying kind of empty truck, procurement cost. And plenty of folks do that. It's relatively, I wouldn't say easy, but it's quite doable. And then it's how much of that full trailer do we think your shipment needs, again, based on past history and And then, the hard part is, we're going to come up with a percentage effectively of what's the likelihood of that shipment finding a companion shipment when it comes back. So you don't know when it's going to move. And we're also solving for appointment times, right? Because we're never going to rework your freight on someone else's dock. And so everything's loaded last in, first out. So as hard as it was before, now we've got to account for the constraints, right?
What?
So all that will go in. And so it's the pooling probability is fundamentally dictated by the size of the shipment and then the density of the corridor. So high density corridor, then higher likelihood of your shipment's going to pool.
But let me ask a question, because you're operating more. Are you finding yourself being, used strategically with a shipper within their routing guide where flock shows up for a quarter, I don't know, like you said, Ontario, California to Dallas, and it shows up in there, and then they choose
We
to
are
use?
now. And so
Okay.
early days, it's, you prove it with, mostly SMB middle market shippers where, they're a little more flexible, a lot more flexible. They're operating on spreadsheets. So part of it is just kind of the enterprise tech monolith
Yeah.
around. So, so you prove it, you get, escape velocity at the lower end of the market. And then as we've scaled up and service has gotten more consistent, then that gives us the right to go upstream and sell to enterprise shippers where you've got the TMS monolith, but also more rigid operating requirements as they should. Appointments more likely than first come, first serve. All that stuff. You have to meet them where they are. This can't be, hey, here's a great solution, but here's a dozen different compromises.
Yeah. So my question is, if you're going to be in the routing guide, that means you're in the RFP. You're getting brought in there. How do you set the pricing? Because this reminds me, I'm a nerd, right?
Yeah.
This is a news vendor problem. You have to go in assuming the probability that you think you'll find something on that corridor. So how do you do that? Is
so
it
I
just
tell
magic?
this story about any enterprise shipper, hey, what does Flock do? What is Shared Truckload?
Yeah.
Here, it's okay. You save money, benefit the environment. You would touch less damage. Like, hey, fantastic, right? Where do I sign up? I've got, I'm not, all the trucks aren't full. It's one, how do I price it? Right? Because I don't have a Shared Truckload column in my Jagger or RFP thing, or how I use market. And then two, how do I ingest your rates into my TMS? What's OTM, E2 open, Mercurgate, right? You pick yours, right? There is no Shared Truckload lane to go down. We think over time, there certainly should be. At the end of the day, it's just, as long as you've got some version of dimensions that you can reference, and it can be PAL positions, weight, volume, cube, whatever the case may be, you have it if you're thinking LTL. You may not have it if you're usually thinking truckload, but if you have some version of dimensions, and there's a bunch of creative ways you can figure that out, our vision is that someday that all those loads are going through the optimization. Okay, here's your LTL rate if you have one, depending on how small it is. Here's the cheapest truckload carrier in the routing guide. You know what that FTL rate is going to be. Pull a shared truckload rate. You know what that is, right? Shared truckload service. You may share the space with somebody, but it's different than LTL. You choose based on what you're trying to solve for that shipment. And so that part, as we've gotten further along in this journey, we've had much more success. I don't think there's a single commercial TMS that we're not in somehow, but different shippers have had to kind of bespoke this in different ways to make it work.
So, no, it's funny. It's funny. So bespoke, which I call hacking, right? Same thing, but 2 points. One is the beautiful thing about being included in an RFP, you're now bidding on corridors. You can pick, you're not saying from
this point to point. Yeah. So we'll do a bid, we'll do point to point. So we can give you a truckload rate, and then it's depending on, if you can give us a load history, and if we know this, if we believe that your ship probably will be like how it was, in the future, we can give you rates assuming a certain, average utilization, or, ideally we can give you rates based on either linear foot bands, right, pallet positions,
right,
have a way to ingest it, or what the cab truck rates.
But the interesting thing is, so you're going on the truckload, but I would imagine, I hadn't thought of this fully. The TMSs tend to do their optimization, their LTL to truckload conversion. They're too bad.
Ridiculous. It's someone did a consultant came in like 10 years ago and said anything over like 14 feet goes truckload, anything below 14 feet goes LTL, and never a revisit was made. We'll say insane. It's insane. Don't do that. Here's something that captures it. You should be able to get a price point based on the dimensions of that shipment. We can cover you anywhere from 0 to 44 linear feet.
But you got to understand that logic. When is the truckload tipping point? And we always look at this and you can see where it falls. And as truckload rates drop, it validates a smaller and smaller load. That's because the third option, wasn't there.
It's never been there. So it's crazy. So you look at you're hitting like that 14 foot or 20 foot or whatever it is for the individual shipper, and it's like, oh my god, even stuff that's tripping, you've got 30%. And again, some of the trucks are full, and for a full truck, you're probably not going to pick Flock because that's not what it's built for. We're happy to do it, but we're not going to give you a price that's any more competitive than anybody else.
Right.
For the 40% of the truckload shipments, or some case 80% that aren't full, here's another price point to consider.
So what is the biggest hurdle that you see for adoption of this? Is it getting enough demand like this, getting enough capacity to take care of it, or the technology to enable the shipper to even identify this as an option?
It's change management. That's what it is. At this point, I think we've captured, I guess what I said, that we've shippers understanding kind of what it is and how it's different. And the shippers that understand how it's different and see opportunity, which usually means you have some of the dollar sign in front of it, in their operations, are the ones that are leaning in, and they'll figure out, if we need to, tweak something within the TMS waterfall or how we're personally rates, they'll figure that out. Or oftentimes, if they've got a contract that requires a seal policy, which is completely normal in a truckload environment, you're trying to explain to legal why that would compromise what Flock, what this was built for. And if we're signing a seal policy, this is how we'll address your need, but this is how we protect your freight in the meantime. Well, I mean, right now it's a live product, right? So over time, we'll get better at creating drop trailer. But think about if there's a drop trailer scenario, it kind of cuts off half of the pooling universe.
Right.
So if you drop a trailer, it's not going to be any freight in it. You're going to have to put that shipper's freight on the nose, which is fine. And then we need to count on that we'll have something to pool with it from origin to deliver before its final destination, which you can do, but it cuts off half the universe.
Yeah. And it's another complication that restricts the solutions.
So it's a trade-off. So all these things, you have these supply chain policies that have developed over time where it's, okay, I want drop trailers because I'm trying to optimize for the operations of the warehouse, transportation not as much of an issue. It's, well, hey, if we could get more live load appointments and you could save X dollars, is it worth revisiting this policy where, hey, can you give us more live load appointments at night? So it becomes this, understanding the trade-offs of the transportation, can have a conversation with warehousing to figure out what makes the best sense for the organization.
So this reminds me of something that seems totally unrelated, but let me see if I can bring it back in. I'm just finishing an article that I'm going to submit for this. Do you know what a desire path is?
No.
So and think of this because I'm in Boston. We've got 2 feet of snow.
Sure.
And they plow certain paths, but people will find their own way. They'll create a path through the snow. You saw this in Chicago, right?
Yeah, or even was it the college campuses? It's
yes.
like, I'm not going to put the paths in. I'll wait and kind of observe where the dirt.
Yeah. So they call that a desire path. Sure. And the thing is that the gut reaction, a lot of people, is to block the desired path because keep the people on how I want them to go. And the same thing happens for decision support systems. When you have someone who violates or doesn't do what the system is saying, they're hacking it. And the gut reaction, having developed software before, is find ways where they can't do that.
Sure.
Stop maverick buy or maverick behavior. And what you're describing right now is Flock is kind of in that third path that a lot of systems, it's not an option. And so you've got to hack or be bespoke for that. So my point to all this is you need to look for where your users are hacking the system, because that's telling you that the system isn't behaving the way it should be. Follow the user's behavior, and there's opportunities there. And it sounds like what Flock is a desire path, and you've got to help the system go to that. Does that make sense to you?
100%. And so as long as there's a financial incentive is usually what drives all. If you can demonstrate a financial incentive, then all of these things are solvable. Where it's okay, whether it's drop trailer, and again, we do have drop trailer pilots that we're doing, so it's not all at the table. This changes the math. Or some shippers will, some LTL networks, you do some terminal to terminal moves where the trade times are so tight, you don't have time to pull anything after that shipment. So if you're going to pull, you have to pull in the front end. Where you have something else that's in the nose, shipper stuff gets put on the back, you deliver that shipment, and then you drop what's on the nose. So
you alluded earlier to another benefit that Flock does, and that's sustainability.
Yeah.
And sustainability comes and goes with the price of diesel sometimes, how I interpret that is. But how are you seeing that now? With the new administration, it seems less of a push on that. What do you see as the appetite from shippers for achieving sustainability goals?
I mean, it's definitely there. I mean, ultimately, that's Flock's ultimate mission. I think we're one of the few B Corps, right, that I know of in freight. We're an established B Corp. It's literally written into articles of corporation around we can't compromise on our mission of mitigating unnecessary greenhouse gas emissions, for stakeholder return. Or I think our, kind of hypothesis or our, battle cry all along has been, it doesn't need to be a trade-off. Like, you can do well by doing good.
Yeah, right?
I think traditionally when folks are trying to, drive emission reductions, it's, hey, can you use, battery electric vehicles only? Well, yeah, but it's going to, 2 extra trans spend. Do you want to do that? No, let's wait. We're saying there are scenarios where, you can, by choosing different modes and choosing not to, pay to ship air, you're going to save money. You're also going to mitigate carbon emissions. And so, plenty of shippers, right, they're not buying because of the sustainability argument, but there's not one that doesn't care about it, I guess, if that makes sense. And I think the tenor certainly has changed, with the change in administrations. It's no longer a stick where you had, different states and and laws on the books that were, kind of forcing this. So I think that that force isn't there in the same way. But there are plenty of shippers out that still have a sustainability program. They still want to be able to measure it. So we go to great lengths on, getting our methodology and our calculations kind of accredited by, global, organized, you said, by GLEC. So it's, we can, they've signed off. So whatever we report up, you can bake that into how you report upstream. It's all based primarily on improving load factors, right? So if you're choosing, and we're inferring, are you choosing shared truckload versus LTL? Because there's different, advantages from a load factor standpoint, or is it versus, truckload, and what are the, average, underutilization kind of factors there? But ultimately, the thesis is by filling up the trucks, right? This is pretty trivial. By filling up the trucks, you take, unnecessary capacity off the road, and you mitigate, carbon footprint, when you're choosing to ship shared truckload.
Yeah, makes
all
sense.
That gets reported. Shippers care about it. If we're kind of on the edge, you got all else equal, shippers will for sure choose shared truckload every time because of that.
And it depends on their corporate culture, their corporate goals, and the industry.
Yeah.
That makes sense. Let me shift gears. Flock is great, but I want to shift to something that you developed initially at Coyote, and it was the first time that I saw someone actually formally describe the cycles of truckload.
Yeah.
Now, someone has sent me an article back from the 70s that showed something, but it was a little different. I think you really brought it together, and you called it the Coyote curve, and then it became
it was the Pickett curve, then it became the Coyote curve.
Oh, is that it?
And now it's Pickett Line.
No, now it's and they're calling it
curve. Yeah, now it's just the curve, right? So
the curve.
Yeah, they're like arcs curve, but the alliteration doesn't.
Yeah, so that's great. But tell me about Pickett research and what you're seeing in the market going forward in 26.
Yeah, so part of the research at Coyote was, hey, I think as an engineer coming into freight and kind of just having a different perspective, try to understand how systems work, as engineers are all to do. And I'm sitting trying to figure out how to broker freight and how does this kind of thing work. And you hear time and time again, hey, this industry runs on cycles. Sometimes, the buyers have the upper hand and they push rates down. Sometimes the carriers have the upper hand, they push rates up. It runs in a cycle. And it's okay, cool. If that's true and the market runs in a cycle, then if you know where you're on the cycle, then cycles are ought to repeat. You should know, generally speaking, kind of what's coming. So that started the whole process. But it's initially built out of a desire to try to figure out how to set multi-year rate agreements. And so, shipper comes in, I want to sign up for 2 years. And
right.
You can, put rates in for a year. And that's hard. We kind of figure it out. 2 years is unheard of. No one does this. And so in my blessed naivety, I thought, well, there's got to be some, formula here that can, figure out how to set an index for year 2 that, balances risk the right way. So I think I threw darts and had some hodgepodge amalgamation of industrial production and GDP, all the things that should impact. I think, the CAS line haul index didn't exist yet. So it was a function of, shipments versus kind of expenditures, and came up with a formula and then went to market, had that in place, and then, went into an upcycle and, all my genius said, hey, what's better than a 2-year contract, a 3-year contract? So that a 3-year rate agreement, based on this, index, and like the first quarter of the third year, this new 3-year contract, all of a sudden spot rates cycled up, went way over, what we had, kind of anticipated in terms of that rate structure. And I'm doing the math and I'm like, okay, we can absorb this for year 1, but this becomes existential kind of after year 2. And, Jeff's yelling at me like, hey, what the heck did you do? And so I think that pain, right, that, that uncertainty is typically the mother of invention. So you kind of figure this out. Well, how can I do this better so we're not, putting the company at risk, and then end up with a bunch of, research and then kind of, ways to cut the data that ended up kind of illuminating effectively what looks like a cycle. And
right.
So that's the observation was, we plot line haul spot rates and using, DAT data. At that time we were using Coyote data, but it's, behaves fundamentally the same. On a year-over-year basis, there is a pretty obvious pattern. I'm, again, looking at, 4 of these patterns. So the data set is not as broad as you'd love it to be, but it seems to be some recurring pattern of overshoot and collapse, where when rates are high, new supply comes in, it always finds a way. It's like the Jurassic Park, life always finds a way. Capacity always finds a way to get in when,
right.
Market rates, demand it. Too much capacity comes in, as, irrational profit-seeking human beings are all to do in a market that's structured like this. And by that, I mean, $900 billion massive market, incredibly fragmented. Like 90% of the carriers have fewer than 10 trucks. Very, very low barriers to entry and exit.
That's, let me dive into that statement. 90% of the carriers have blah, 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 blah. Flipping that 2/3 of the capacity
have a
is in
lot of the carriers,
5% of the
for
trucks.
sure. In
So
terms of, I guess, how the carriers are making decisions, and you kind of see it in the
fair.
state, truck orders, where you can, when markets surge, right, it becomes time for the large, providers to replenish your fleet because what else would you do with that surplus operating income? The most logical thing to do is you invest in your fleet. So you do that. And if you're not adding net new capacity, and you're often right now, you're just trying to reduce your fleet age from 5 years to 3 years or 7 to 5 or whatever it is. Those old trucks go out to the secondary market, and that becomes the on ramp for that long tail carrier to come into the market to go make money in the spot market and kind of live the American dream. And this kind of plays it over and over again. Too much of that capacity comes in relative demand, and the market turns over, and you've got to flush out surplus unprofitable capacity until you hit a bottom, and then you do it all again. And so the observation was, hey, if you kind of decouple spot versus contract rates, because markets behave differently, and you draw this cycle, you start to see some consistencies in terms of durations from inflection to equilibrium to the next inflection point. And what indicators can you look at that help drive that supply? Because it's all supply and demand. If this is all supply and demand, what demand indicators can I look at? What supply indicators can I look at that help you build conviction that this is happening again? Because the forecast is neat, but unless you have conviction on how you got to that forecast, it's really hard to make the decisions. And if you're not making the decisions, then this is the novelty. Hey, neat chart nerd. If I don't believe it, right? How can I actually make financial decisions versus just follow the herd, which is what most of the market does. So in any case, it would looked at that for a bunch of years, and we actually started using it. Like once it became consistent enough, and enough people believed it, that something got rebranded to the Coyote curve because you gotta love that alliteration. It sells well. But I think the big break was to, hey, let's actually start broadcasting this and publishing it. And I've written an academic paper like a year before, so they couldn't claim it as trade secret at that point. And so it's if we can, at the very least, let's start talking about this. So if, again, all my blessed naivety, if more buyers and sellers had more information, could we collaborate better? Like, because the volatility is not good for anybody. This whole, it's not great for the carriers. It's not great for the shippers. If there was a way to collaborate, more transparently long term, would the market behave, more rationally? And as I've looked back, not really. But that was the idea. And so we started publishing, hey, the Coyote curve forecast says X. And of course, all the sales reps, pushed back and said, if we do this, then I happened to be predicting a deflationary forecast. At the time, it's like, well, say what you want, but it was the last time a broker came in and said rates were going down? Like never, right? So, but because here's the cycle, here's the math, and here's the still forecast, and a lot of things can happen in that's a forecast, which I've come to learn. But that ended up becoming a great, just kind of thought leadership tool to go and have it was based on fact. It wasn't us manipulating the forecast to try to drive buyer behavior or get them to take higher bid rates or whatever. It was just based on our best understanding. This is what we thought the market's going to do next year and the year after that, and using that to drive, I think, more transparent, communication with both the shippers that we worked with as well as the carriers. So that became the Coyote curve. It got, out every quarter. And, when I'm predicting rates going up like I'm doing now, then the carriers love me. Procurement thinks I'm a bum. And then when it turns and I'm predicting rates down, then carriers think I'm trying to drive the market down and put them out of business.
Yeah, you know what, though? Shippers, they just want to know. They just want to be proved right because, and we have to talk about
yes, well, unless it's going down, and then they need to explain to finance that, hey, this budget performance wasn't necessarily just me, it was the market. So going up for sure. When it's going down, they tend to not want me to share that with
them. Well, it depends on either thing, because the last 3 years, a lot of shippers have been called, crying wolf, where the market's going to turn, and now, so now we're seeing it happening. But so we've spent a lot of time up here at MIT as well, trying to focus in on the details of where it is. And I think what we're trying to do now is predict when the market shifts. And to me, it's either inflationary or deflationary. You can dock phases of the cycle, but it's really one or the other. But let me ask a basic question. Has it changed? Because the one thing that we're noticing is shippers use more spot, not just because it's a soft market, because the technology has changed. They can do API and connections. They can handle things easier, certain segments of freight that used to be under contract that don't make sense to be. But the second is, do you think the barriers to entry and exit for being a carrier is changing, is tightening a little bit due to some of the regulatory enforcements, closing of the CD mills, some of that stuff that's kind of tightening it up? And as capacity gets tighter, as the barrier to entry and exit gets a little heavier, there's not as much fluctuation. What are your thoughts on those?
It's possible that we get more fluctuation. So again, when I left Coyote, I become so obsessed on this problem of trying to forecast. It's like one of the great joys of my life. It's like people love doing jigsaw puzzles. I cannot wait till industrial production releases on the 15th of every month to enter into the model and try to figure out. I would be doing this if I wasn't in this market, I like to think. So when I left Coyote, it became such a passion where I took the framework and methodology, and now I publish every month under Pickett Research. Now I've rebranded as the Pickett Line because what brand name is better than that? I mean, don't cross the Pickett line. And so, but at the end of the day, it's still
Pickett Line. You know where that the Pickett Line from Civil War.
Scabs are argued. We don't want to like the scabs, and so
no, I'm going way back to Pickett's charge.
Oh yeah, then we're about Gettysburg, kind of cemetery on. He was taking orders. He did his best.
Yeah. Okay, the Pickett Line. I'll go with that.
But then it's still, hey, here's the chart, here's the cycle, and then I've got it's like one chart and like 45 pages of discussion around does the macro support the narrative?
And everyone just takes the picture. We just want the picture.
No one cares. Just want the picture. But ultimately, I'm trying to here's the rationale. If you're going to do something based on this data, you should understand how it was derived, and that's
okay.
One there.
Let's talk about it.
I don't think anything's changed, to be honest with you. I think what I didn't realize, and the battle cry of Pickett Line is, it's not different this time. Like history tends not to repeat itself, but it often rhymes.
Yep.
And like something fundamentally changes the structure of the marketplace, and usually it's the degree of fragmentation or consolidation. I would expect these cycles to continue. And if anything, I think is the spot market's become digitally transformed, right? So, more spot out there on apps. I think for a time, the barriers to entry actually got lower. And so you can actually see the amplitudes increasing where the highs are getting higher, the lows are. This is even before COVID. And so each cycle so far, it's actually getting more volatile, not less. So part of it. So, but what I think I didn't see this time is when, we had, peak COVID and you saw an explosion in operating authorities, and everyone's looking at this massive step changing, operating authorities coming to the industry. And then when the cycle tanked or spot rates collapsed in Q2 of 22, Track kind of estimated operating profit per mile for most motor carriers based on survey data and whatever else versus all-in spot rates. And usually when you hit a cycle bottom, like it never goes net negative. The bars don't go red, usually. The last time it happened was during the Great Recession. That was driven by a fuel spike where it just, fuel spiked or rates did. This time around, you saw the same red bars. It's like, well, heck, how are carriers still in business? Right. So you had the, what's usually kind of a 1.5 year deflationary leg ended up being like a 3.5 year. And these bars were red for like 11 quarters. You're thinking, well, how can this be? And there are all kinds of theories around, sweetheart SBA loans or your super disciplined operators taking your surplus profits during COVID and burying it out in the yard and drawing all that income to subsidize another market, none of which are super plausible. So what I think can happen is, I think if you look at the kind of op expense structure of most motor carriers, it's fuel and it's labor for like 70%. Mm-hmm. So it wasn't fuel this time. Fuel had its own goofiness. But what I think happened was a lot of that, those new operating authorities, that new capacity that came in, ended up developing a cohort of drivers that were willing to effectively take less, basically drive cheaper, had a lot more wage elasticity. Owner operators by definition have a lot more wage elasticity than, our W2 fleets, right, for sure. But the only thing I could figure of what allowed enough fleets to run at otherwise unprofitable levels for so long had to be a willingness or an ability to pay drivers, 60 cents on the dollar. And I'm not saying they're all non-doms or immigrants, but that's certainly, there is an alignment there. I mean, the narrative matches. I think you just had a cohort of carriers that could make money at $1.50 mile. And I'm kind of making up here.
Yeah. Okay. So I can see some of that, and some of that is being tightened out. We'll see if that happens.
Well, I think what's happening now is I think you always have an acceleration of unprofitable capacity that's exiting. And that probably should have happened last year, but then we had, Liberation Day and tariffs came in. And
So my question is, in December of 24, I thought Q2 of 25, we're back. It's the market's tightening.
We might have been on the podcast at the same time where it's, the shape of the curve was, we broke inflationary, right? That quarter. You said, Q4 was plus 5%. I put a forecast where rates are going to be plus 30% by the end of 25. And then the market, then it turned over. And then we skidded along at basically, 0 to plus 2% for about 3 quarters.
I call it the Trump tariff trough. How's that? Yeah, and it just trough,
right? Because I think you had this cohort of sub, wage elastic capacity.
Yeah.
That was still the market, so the market was still recovering beyond it. Demand was still picking up. So I think the force of demand was still overweighing, right, that flexible wage cohort. And then the demand air pocket opened up with tariffs, where all of a sudden, the supply force took over, took it back to equilibrium. And then what's happened in the meantime, you've had a very different regulatory posture where now it's, whether it's immigration enforcement, closing down non-dom CDLs, enforcing EPL proficiency, where it's almost accelerating now and almost catching up for all the supply exit that probably should have happened, last year, but a much faster pace. So the demand overhang is still there. There's, demand is lower. Like any market you look at, there's less freight demand in the market based on ATA, based on the cash shipments index. So what's happening over the last 3 months is not demand surging, it's supply, reset, or maybe that marginal carrier is no longer at $1.50, now they're at $1.85.
So we only have a couple minutes left. So what's your prediction for what spot rates will do? We're in February right now, called the end of February 2026. What do you think it'll be at the end of 26, in December 26, January 26?
So again, so Pickett Research put out a St. Valentine's Day, shipper special, or the pitch was, I think there's a lot of shippers are unprepared for this, right? Because they've been conditioned to believe the rates can't surge higher without a demand spike. If they're not expecting a demand spike, they'd come into this year probably a transportation budget that's maybe +0 to +3%. I haven't talked to anyone who's got more than 4 or 5% pegged. And I think spot rates are going to be, at current forecast is +45%, so 45% higher on a year-over-year basis, spot line haul rates, which would basically be 20 to 30% higher from our current levels, which are elevated. So spot rates 20 to 30% higher. I think contract rates, top out at probably +10% year-over-year in, by Q1 2027. So spot +45%, contract +10%. I am expecting some level of a demand recovery by the back half of the year. Mm-hmm. If we don't get that, somehow we end up in some version of a recession, or we somehow figure out to make,
and you're talking, these percentages are mainly dry van for the most part?
Yeah, it's a blended index, so it's overall capacity. Okay. And so again, I take 80% van, 15% reefer, 5% flat out of the DAT app.
Yeah. So you're saying roughly about a 10% increase in contract rates you're seeing over the year, and about 20% in spot, which if you combine those together is probably the spot of a 20% increase. You're probably going to have maybe 10% of your volume, maybe 20% of your volume goes spot. So that adds another 2%, 4%. So a total all in 14, 15%.
Ish. Yeah. And, but okay. That's going to be the big trade-off. It's that spot versus contract. And part of that's what drives the cycle where, because contract lags spot, and there's reasons why that's the case.
Well, absolutely.
Anyone who went out to market last year probably even saw rate decrease. I've even heard some shippers actually got, 1, 2, 3% concessions, are now in very different markets. Now the battle is going to be, every broker and shipper carrier out there is trying to figure out how much my contract freight can I say no to? How much risk do I want to take on my primary tender acceptance?
Yep.
So to mitigate the financial pain if I'm a broker because I'm buying in the spot, or to, expose more of my fleet to a more attractive, spot market if I'm an asset-based carrier. Yeah. Every organization is trying to figure out how to keep more of my carriers taking my contract freight at contract lanes and minimizing reprice.
So what the shippers are facing now is, whenever you do an RFP, this, you ratchet. How much do I save? How much do I give back to the carriers? And I think the acceptance is a 3 to maybe, I don't know anyone who's saying, let's give them 10%. That's not, I'm not seeing that as much. I'm not as, I'm a little more conservative than you. I'm about half of what you're seeing, but we'll see how that is. We'll see. We'll have you back on. We won't wait 6 years, Chris. We'll have you back on. I
get the whole point. Even with kind of shared truckload, back to what Flock is offering, it's, if you're already feeling, right, some budget concerns, or not even at a kind of Q1, you're not going to get, and you already, some shippers are even, tasked with, I don't care, I need you to find 2%, reduction in transport, because the overall market's still, wobbly, and a lot of folks are struggling from a revenue standpoint. You're not going to find savings reprice your truckload. I mean, that playbook worked over the last 3 years. Our perspective is, hey, here's a way, if you're not using shared truckload already, as a starting point, at least stop paying for inflated truckload capacity pricing that you don't need. So you're not screwing your carriers. Here's a different code to consider where, hey, maybe the numbers didn't make sense last year because the penalty cost of shipping air was super low. As the penalty cost of shipping air surged to plus 45%, I think the math is going to change pretty quick.
Well, I'd be very disappointed if you didn't pitch Flock in the very last comment. So go right on there. Chris, thank you so much for joining me today. It's always a great conversation. Like I said, we won't wait 6 more years.
Much appreciated. Thanks, Chris.
Great. Thanks. Okay, everyone, stay tuned for the Truckload Market Update. Good morning. This is the Truckload Market Update for 5 March 2026. For dry van, we saw the contract rates drop slightly, 0.5%. Also, spot rates dropped slightly, 0.3%, and the current level of replacement rates for dry van is positive 1%, with the market gap between spot and contract 11 cents a mile, where spot is greater than contract. In temp control, we saw contract rates also drop 1.5%. Spot rates also dropped slightly, 0.1%. And we saw the current level of replacement rates in temp control be positive 4.9%, quite the jump from the last period. And the market gap between spot and contract for temp control is 18 cents a mile. Intermodal found contract rates increased 0.9%. Spot rates really increased 7.9%. But remember, there's not that much spot when you talk about intermodal. And the current level of replacement rates for intermodal is negative 1.3%, with a gap between spot and contract about 19 cents a mile. Finally, flatbed. We saw contract rates increase 1.2%. Spot rates increased 4.3%. It's been on a tear in the flatbed world. And replacement rates are down 4.2% for flatbed, with the spot and contract differential, the market gap, negative 3 cents a mile. That's the only mode where spot is still below contract. Okay, what have we seen? Dry van, temp control, intermodal all continue to have slight contractions in their contract rates, but it's more of an adjustment. They're still 1 to 4% above year over year. And spot rates also, we saw a little bit of a correction, especially for dry van and temp control. They're cooling a little bit, but they're still up by almost 20% for dry van and 19% for temp control year over year. So they're still way up there. They're just cooled a little bit from the January, the holidays and the temperature and the weather things. Replacement rates are mixed. Temp control jumping up, like I said, almost 5%. That's a big jump. We'll see if that continues. And the gap between spot and contract, again, is positive for every mode except a flatbed, which is getting there. It's getting there. And so we are definitely in a tightening market. Capacity is getting a little tighter. Haven't seen demand skyrocket up, but we have seen a contraction, especially in the small carrier base. So that's the state of the market on 5 March 2026.
And that's a wrap for this episode of The Freight Vine. The Freight Vine podcast is hosted by myself, Chris Kaplis, and is produced and edited by DAT Freight and Analytics. For more information or to catch up on previous episodes, swing by our website at www.dat.com/resources/FreightVine. And don't forget to hit that subscribe button wherever you listen to podcasts. And hey, why not drop us a review while you're at it? If you have any feedback or questions about what you've heard or suggestions for what you'd like to hear in the future, please send an email to me at chris.kaplis@dat.com. That's chris.kaplice@dat.com. And finally, a big thanks from all of us at DAT for tuning in. We hope you learned something new and you come back again.